Our next presenters, Tenaz Energy. They're a Canadian international E&P company. We have assets currently in Canada and offshore Netherlands. They've combined a strong technical evaluating and operating capability with their international sourcing history, and they use an acquire and exploit strategy and are targeting assets in Europe, Middle East, North Africa, South America. And here to give you the complete story is Tony Marino, their CEO. Tony?
Okay, good morning, and thank you for that introduction. It's great to be back at EnerCom, and it's great to be back in Denver. I used to live here, and it's always a pleasure to come back. So before I get started on Tenaz, I'd ask you to note our disclaimer and our advisory on forward-looking statements. So Tenaz is a public E&P. We're on the TSX, symbol is TNZ. Strategy, as we heard in the introduction, is acquire and exploit in the international markets. I'll explain why we prefer that to working the same strategy in North America in a few minutes here. Current asset base, we have an early stage oil growth project in Canada, and we have non-operated assets in the Netherlands. We're debt-free. We've demonstrated, we feel, our access to the capital markets previously. We last month announced a very key deal for us, the acquisition of NOM Offshore BV, or NOBV. This is from a 50-50 partnership of Shell and Exxon. That transaction expected to close in the middle of next year, and I'll discuss that at some length later in the presentation. Market cap today, about $220 million, about a $180 million EV. And when I refer to these monetary values in the presentation, they're all in Canadian dollars. It's about a 73.5-cent dollar as of today. Positive net working capital. We'll talk about our guidance for this year. It doesn't include NOBV, 2,800 BOED at the midpoint, 24 million midpoint CapEx guidance. A lot of management and director ownership, 10% on a basic basis and about 22% on a fully diluted basis. We think that's very important to have that alignment between the team and the entire shareholder group. I won't go into detail on the executive group. We've been together a long time. A lot of us come from Vermilion, Baytex, Dominion before that. I'm joined today in the audience by Brad Bennett, our CFO, and by John Bulkwill, our VP of Business Development. We got a great board. Chair is Marty Proctor. He was the CEO of 7Gens. 7Gens bought by ARC. He's now on the ARC board. This board really has all the expertise set that we need to guide us. We've got audit, we've got capital markets, we've got legal, and operating and sustainability. A great board and a huge asset to the company. Talk about the vision of the company. As mentioned in the introduction, we're a very technical team. Really stress engineering and geoscience, trying to make accurate evaluation on these acquisition projects, and trying to be very disciplined in the way we go about making offers on them and structuring the transactions. There's a lot of risk in the oil and gas business. There's a lot of price risk, particularly, and there are some ways to control a part of that, and we'll talk about that, for example, in NOBV. What we're seeking to do with this very technical approach in acquire and exploit is to try to take as much of the controllable risk out of the equation as possible. The strategy will employ conventional production. We're seeking conventional production, and oftentimes we feel we'll get an option, typically a free option, in the overseas market on semi-conventional development, and I'll explain in a few minutes what I mean by that. We adopt quite a wide funnel in looking at acquisitions. I'll talk about that geographically in a minute. That's a way we feel we can be exposed to the best deals and build the company to the kind of size that we seek for the longer term. And of course, we're after free cash generation. In the producing assets, we will get that immediately. When we develop, we want rapid payouts and begin generating FCF in this public market growth and FCF model that we are running. Cornerstone acquisitions, such as the NOBV transaction that we recently announced, will give us an operating base in our key regions that we can accrete around and get the maximum level of operating economies of scale, Ultimately, we're seeking to build this company to 50 to 100,000 BOED, value-based, but we know that we will need greater size over time. And that should give us good operating economies in the 2 or 3 regions that we focus on and give us adequate capital market scale as well to be a mid-cap producer. The types of assets that we're going for first, before I get to the map, again, it's conventional production. Oftentimes in the overseas market, we will get a semi-conventional option at the same time. I think we all know what I mean by conventional permeable production, primary, secondary recovery. Semi-conventional, in our terminology, would be pursuing tight reservoirs, not ultra-tights, not the shales, but tight sandstones and carbonates, conventional traps, but use horizontal wells to develop them. Could be multilaterals, could be single laterals stimulated. There hasn't been very much of this that has occurred in the overseas market, often unrecognized, but these tight reservoirs typically exist in the strat columns and in the vast majority of the basins. And it's typically a free option that we would get as we acquire the conventional production. Why do we go internationally as opposed to North America? The team has worked for a long time in Canada and the US as well, with success in acquisitions, but today we see just a higher return opportunity internationally. There's 2 steps to this. The first is that there is less competition on these base acquisitions. There just aren't that many well-funded teams that have the operating expertise, even the ESG expertise, to be accepted in these jurisdictions. We typically, in the projects we work on, we might go against no competitors, completely negotiated deal, or maybe 1 or 2 competitors, and that's really key to getting a good low multiple at entry, a good base level rate of return to go against very little competitors, because it holds down the consideration that is needed to be paid. The second element is also very important. In the overseas market, we feel from our experience for a long period of time working both North America and overseas that there's a greater opportunity for operational improvement in these assets that we would be acquiring. For one thing, we're acquiring typically mid to late life assets from big companies. These aren't the types of assets that get a great deal of focus. Typically, they're very underinvested by the big companies because they can't move the needle for them, and they're ultimately the target of strategic divestment by them. And in a more general sense, the North American industry is very, very efficient. I mean, previously we worked a lot and we had success acquiring and improving performance, but we have found in comparison to our work in the international markets that there's a much greater improvement available. The overseas industry simply doesn't have quite the level of efficiency that these North American producers have achieved. So you put together better base rates of return with more operational improvement, and you get very high returns on capital. The map here addresses the geography of what we're seeking. So there's 2 colors, dark blue, light blue. They represent the jurisdictions that the team that we have has worked in historically. The dark blue jurisdictions would be the ones that we would, at least at first inspection, consider for acquisition projects. Regionally, the main area of focus, the primary area of focus for us is Europe. Secondary area of focus is Latin America. Early on in the history of Tenaz, we identified MENA as another target. We just haven't found that much deal flow. Theoretically, it's still available to us. And there's some optionality to expand in Canada, although it's not our highest priority out of our existing asset base. We've had success in the US before. It's a great industry. It's where I started my career, but we probably won't come back to the US to compete anytime soon. Tenaz was created as a public entity by recapitalizing almost exactly 3 years ago an existing Canadian public. That company was Altura Energy, very small company. I think it had about a 17 or 18 million market cap on the TSX Venture Exchange. We looked at the Altura assets, saw good value in Canada, approached the Altura board with a strategy change and brought in capital. The Altura board agreed to turn the company over to Tenaz. We renamed it. We listed on the TSX big board in the early part of 22. So in that 3 years, we have tripled production, up organically in Canada, plus we added a non-op gas position in the Netherlands. We've had about an 8-fold increase in FFO. That's driven by production and better pricing, particularly with the TTF. At the same time, we have built a larger positive net working capital balance, negative net debt. We have bought back 7% of the shares in that time. So we started at $1.80 3 years ago. We're currently about $8 a share. There's 57 total E&Ps that are traded on the TSX. Last year we were second out of 57. This year to date, we're first out of 57. So that is the operating and capital markets record of the company to date. I'll talk for just a minute about the Canadian assets that we inherited from Altura. We've expanded the project a little bit since then. It's a great field that Altura found, shallow, 1,300 meters, Rex formation within the Manville. It's developed using horizontals. We've gone longer, more stages, different designs, about a doubling of production. We've identified some additional Manville intervals to pursue, some probably with multilaterals, unstimulated. There's a lot of infrastructure here available to accommodate increases in production, and we do expect to kind of ratably increase production for a number of years here while it throws off FCF. In fact, FCF sufficient even to cover the headquarters G&A, it's just a high value project that we've retained in the portfolio, even though Canada is not our main focus. Not a cornerstone asset, but it's a good source of value for the shareholders. The second asset that we have today, this is all before the NOBV acquisition, which won't be counted in our results until we close in a little bit less than a year now. Second set of assets is these non-operated Netherlands gas assets offshore. It's a little bit under 1,000 BOED currently. It's almost entirely TTF natural gas. You can see the pricing here. Next year's strip, $18 MCF, significantly advantaged versus North America. Along with the upstream production, we got a midstream asset I'll discuss in a minute. We also have the opportunity to invest in a CCS project. That project has not been fully evaluated or sanctioned yet, probably a decision over the next year or so, but it'd be an 11% interest of a big project that could store up to 5 megatons a year. So there is potential beyond the existing production base, both in gas, fields that have been discovered, but not tied into the platforms at this point. That's in the ENI gas-operated area in the south. In the Wintersall oil area in the north, there's a couple significant oil discoveries. Light oil within the Chalk Formation, Vermeer and Rembrandt, pretty big fields. They could projected to make 20,000 oil a day. We have a 5% interest. That'd be 1,000 oil a day net to us. And a decision on that hasn't been made yet, but if it is FID'd, we'd probably have production in about 5 years from that new development. We also have a midstream asset that came in these non-op acquisitions that we did last year. It's called NGT. We have a 21% interest, a very large gathering system covering kind of the eastern third or half of the Dutch offshore and onshore processing to go with it. Very large system with a lot of capacity, very high reliability. It's certified to transport hydrogen, ultimate energy transition of producing offshore hydrogen and sending it to shore could add a lot of value to this system. And it throws off a lot of cash. $27 million to the owner group. We get 21% of that. It's a start of our midstream business, and that'll be added to with the NOBV acquisition as well. So you put the two existing assets together, creates our current guidance level, lower right, 2,700 to 2,900 BOED, 23 to 25 million of CapEx, plus $2.5 to $3 million to evaluate the CCS project. Product mix today is split between Canadian oil and TTF with a little bit of residue AECO. On the upper right, we do hedge the gas. We're unhedged for the oil. You can see the big difference between AECO at the top and TTF below it. AECO, the hedges, $2 to $3 an MCF. TTF range is $14 to $19 per MCF. This is one reason, a strong reason we prefer overseas gas to domestic. We're going to continue this year to drill a few wells in Alberta. We're going to evaluate the CCS. Very key effort is that operational transition of NOBV with the closing projected mid-year, and we're going to continue our M&A program. I feel we've got a very strong M&A pipeline. It's diversified in product type, diversified in jurisdiction. I don't guarantee any particular deal announcement out of this, nor do I speak to the timing, but I have to say I like our M&A pipeline that we have better than I have at any time in the 3-year history of the company, and we're not going to stop just because we're in the midst of the NOBV transition. We're going to continue from our Calgary staff to advance the projects in that pipeline. Now I'm going to turn to the NOBV acquisition, very important deal for us. So again, this is the acquisition of offshore Netherlands gas assets from NAM, a 50-50 Shell Exxon JV. It's a significant deal for the company. It's a big step up that is exactly in line with the strategy that we enumerated when we created the company. It's a significant operated position. We want to control our asset base wherever possible. Here, this will be about 1/5 of the offshore Netherlands production. And I would say that the Netherlands government is very supportive of investment and production growth in the offshore to ensure a greater level of energy security for the country. Third, I'll show you the deal terms later. It's a high rate of return acquisition, structured so that the upfront payments are lower with some contingencies. We are not planning to issue equity to close this deal. Those benefits should flow to the existing shareholders. Fourth, we've seen the pricing in TTF. It is high margin production. We've hedged nearly half of it for 3 years to lock in those prices and we hope ensure quite a high level of free cash. Finally, even after closing the deal, we should have quite low leverage, almost de minimis leverage in the company. So in terms of the assets, the production is Rotliegend sandstone. It's been the cornerstone of the European industry in gas for a long time, very well understood, we think quite predictable. The assets are in excellent condition. When you have a company like NAM, owned by Shell and Exxon, it has the highest standards of asset integrity and employee development and operating HSE standards you could find in the industry. Third, it's very strong with respect to the infrastructure. We've got the pipelines and the onshore gas processing that goes with it will allow for growth in the assets, and I'll cover that in just a second. And finally, it's quite low base decline, on the order of a 10% base decline, permeable Rotliegend reservoirs, quite a low level of reinvestment for the past decade. We see a large number of workover, development drilling, stranded field tie-ins, and ultimately exploration drilling as well. So in terms of what we are getting specifically in NOBV, you can see this in the blue blocks here, 11,000 BOED net to our interest of TTF production, almost entirely TTF, just a tiny bit of Condi with it. Per independent assessment by McDaniel, 54 million BOE at the 2P level in reserves. It's concentrated in 6 offshore hubs, and there's a lot of processing infrastructure that goes with this. The pipelines to shore, a gas plant on shore that has a nameplate of 3.4 BCFD. I think it's the largest nameplate in Europe. In terms of the geographic distribution, the map on the right shows the relation of the offshore tracts in Netherlands compared to onshore. So we currently own in the blue licenses. That's a non-op position that we put in place in 23. We will be acquiring the yellow production licenses in the south and the orange exploration licenses in the north. All told, on a pro forma basis, if you put them together today, it would be around 12,000 BOED. We would operate about 80% of that number. Assets together with the existing over 55 million BOE at 1124 per McDaniel, about a 13-year RLI, and a lot of midstream infrastructure, pipelines and the onshore plant with these assets. In fact, if you take the NGT on the east side and this central set of midstream infrastructure that we get in this deal, the total cash flow generated by that alone would be on the order of 10 million euros a year to our interest. The reserve report I won't cover in detail. McDaniel's assessment, actually on a price deck that is below the current strip, as at the effective date of the NOBV transaction, January 1, 24, shows a 2P ATAX NPV 10 of 800 million. That compares, as I'll show in a second, to upfront consideration at 1124 of about $250 million. So we think a significant value add. In terms of the production profile, McDaniel forecasts a mitigation of the base decline and ultimately an increase. We think the report, a good one done by McDaniel, but still we see a number of projects beyond those recognized in the 2P report, and of course no exploration reflected in this. In terms of upside that goes beyond what McDaniel has recognized to date, in our own internal assessment, we see a great number of potential development projects. Something like 20%, I think 3 or 3.5 net wells is counted in the McDaniel report versus the number of potential development drilling projects. There's a lot of workovers. There's a very good exploration block to the north, and of course no exploration would be reflected in the 2P report. It's about 700,000 acres in total in the yellow and orange lands. It's all covered by 3D, and in fact in the key producing area in 22 there was a new ocean bed node seismic survey shot, a new OBN 3D, geophones on the seabed, very high effort, very high quality data. It's still being processed, hasn't been interpreted, and we would expect out of that to have quite a bit of additional identification of infill drilling, extension, and some exploration in the current producing area. The next two slides are going to detail the acquisition structure. This first one shows the 4 components of consideration in the transaction. On the upper left, we have the base purchase price at an effective date of Jan 1, 24, converting the euros to Canadian dollars, 246 million Canadian. I'll talk in a minute about how that number gets reduced by cash flow in this expected 1.5-year interim period. There's a contingent earnout shown on the lower left. This would be a share of the free cash flow minus capex that we would reinvest, the free cash for 25, 26, 27, half for 25 and 26, a quarter for 27. There's no minimum we have to pay here. It's capped out at a maximum of 120 million euros. If we fall short of 120 million euros during that period in free cash, there's no additional payment required from us. There's an exploration contingency on the upper right. If we make big new field discovery at a certain point, it'll kick in with a royalty. We'd be very happy to pay that. And on the lower right, we have a price contingency that will kick in at the end of the contingent earnout period at prices that are way above the current quite strong prices that you have in TTF. That last tier of sharing on an ATAX basis hits at a price of about $26 an MCF. So we'd be in very good shape if these are ever invoked as well. Particularly with respect to the base consideration, this slide goes through the detail of what we would still have to pay at close. So 1/1/24 price, 246 million Canadian. In an 18-month period, we would project, depends on prices, performance, about 185 million Canadian of free cash out of the properties. That leaves you roughly 60 million. We put about half of that in a deposit. We may have to acquire some working capital. Not completely clear what that number would be at this point, but we expect that we would probably be paying something on the order of 45 million Canadian at close. That amount is fully financed by a National Bank of Canada line that we have put in place to fund this acquisition, along with a new revolver for the company. So the financing is fully taken care of. We really don't expect to have very much leverage, perhaps if any, at the closing of the transaction. This is represented on the lower right. We do have net working capital in the company today. We will have, we think, free cash flow in the base company in the interim period from here. So we may have a very de minimis amount that we would show probably as positive net working capital at that point. Of course, depends on any further deals we might do. In any case, an extraordinarily low level of leverage in the company. On the upper right, we have hedged 46% of the production for 3 years, prices ranging from 13, a collar or the floor of 13, and swaps with pricing of $14 to $22 an MCF to lock in a lot of that cash flow. So we think it's a good deal, not that much upfront consideration, really not that much risk we feel to Tenaz. The pro forma of the company, just very briefly, represented in the pie charts. TTF, in the absence of other deals, will be the dominant exposure in the company. We will have a component of midstream cash flow as well. Canada continues to grow, pays for its CapEx, and pays for the headquarters G&A. It's on the lower left, it's a huge expansion, 4x increase in production, something on the order of a 24x increase in free cash. And on the lower right, the entire company on a pro forma basis, existing assets plus NOBV, McDaniel has a NPV 10 ATAX at 1124 of about 930 million. Got about 180 million EV today. The transaction consideration before any contingencies is about 250 million in comparison to those that 930 million NAV number. So in conclusion, we see deep value in the international market. We're going to, we think, make higher base rate of return deals, have a good opportunity for operational improvement with focus on Europe and Latin America. Secondly, it's a strategy we've run before, a great deal of experience within the company, evaluating, negotiating, closing transactions, and we've used it previously in a growth and FCF capital markets model. And the final point, we are aligned with the rest of the shareholders, management and directors invested in the original recap, and the entire team that we have is incentivized with equity to deliver for the shareholders. So thank you for your attention, and perhaps we'll see you in the breakout session after.